Okay, guys, 14.3 is on promissory notes. So a promissory note is what it sounds like, a promise to pay money back. So we've learned about buying and selling on accounts payable and whatnot when you charge. But sometimes people need an extension because when it comes time to pay on those accounts, they cannot pay on them. So they need an extension. So they ask for a promissory note, which is it's written and signed to pay back a sum of money. Usually, and then there's a set of days, the date on which the principal, it's from the time that you take it out to the time that it's due. That's called the maturity date. And just like anything, if you borrow money or you can't pay, you're going to have finance charges. And in this case, you are going to have interest charges. So that's always the downfall of not being able to pay your bills. You get those extra charges. So you can read about it, but it tells you that the person that if I was to take it out, I am the maker of the note. And then the amount you owe, the payable is the payee. You have a face amount, then your principal amount. You have your interest rate, your maturity date, which is the time of the note, and whatnot. And then this right here, 425, kind of will show you an example of a promissory note. So today, we have to take this and we have to figure out how to calculate the interest and the maturity date. So, we know that a promissory note is a note payable to the customer and a note receivable to the business, because the customer is supposed to be paying it, the business is supposed to be receiving it. So your note's receivable, your debit will increase and your credit will decrease. Okay? And this, if somebody's not paying their bill, usually trying to do a promissory note is another alternative to trying to make them pay and encourage them to pay the amount due. So you can see in your general journal, when you have one, you'll have your notes receivable, like we said, will be debited, and your accounts receivable, Skinner College, will be credited. So how exactly, we're going to figure out how to find the interest owed. We know whatever they owe, and they take out the promissory note for, that's the principal. And then their interest rate times the days that they have, because if they only take it for 3 months, they only have to pay interest for the 3 months that they signed the note for. They don't have to pay it for the entire year. So that you have to figure out the number of days that they're paying interest on. And the time used to calculate the interest is used by however many days that they take the loan out, divided by 360 days. So if somebody had an 8% interest rate, as it tells you, that means that for each dollar borrowed, they're going to pay about 8 cents for each dollar borrowed. So if we look here, Skinner College, they took out a note for $25.78.35. So that goes in our general journal, what they owe us. Then we have to come over here and find out how much interest they're going to pay to get their maturity value. Okay, and we figure that out by taking the rate by the time of the year, or how many days they're paying interest on. So this is probably where it's going to get a little confusing for you guys. But you have to figure out, so this is 90 days, right? They took out this note for 90 days. So they only have to pay that 8% interest on the 90 days that they took it out. So we know they took it out on March 18th. So March 18th to March 31st, that's 13 days left in the month. So then they have 77 days left of the 90 to pay that bill. We know April has 30 days, May has 31 days. So if you add these up, if you add 13, 30, and 31, 13, 30, and 31, you get 74. So you're at 74 days to your 90 days. So yeah, so you have 16 days remaining, right? This tells you have 16 days remaining. So to get to June 16th, because that's when you're June 16th, March 18th to June 16th is 90 days. So that is when your promissory note is due. So 0 days remaining. So that's how you figure that out. So from March 18th to June 16th is how long they have to pay on that promissory note. And that's 90 days, because that's what they took it out for, 90 days at 8% interest. Okay, and I will walk you through that again. And then it tells you how your notes receivable, your interest, when you do your interest, it debits and credits. So then in your cash journal, you'll have because this is our general journal, we're writing in our general journal. Okay, now in our cash journal, we have to record the transaction to record the receipt of a note receivable in the same way, regardless if it's signed or not. So notes receivable, so our principal amount was $2,578.35, right? Then we add our interest. So the total cash that they're gonna owe back on that promissory note, $2,629.92. So what happens if they don't pay that in the 90 days? Then you have to record a dishonored note receivable. So we're gonna do, just like we did before, the exact opposite. We have to put, if they don't pay it, note receivable, it's changed back to an account receivable. So that's in our general journal, right? Because we already recorded this notes receivable in our general journal. So now we have to go re-record it because they didn't pay it. So that notes receivable account will show the value of notes that will probably be collected, and the accounts receivable account, it should show the customer's history, because obviously these people, if they're not going to pay their bills, and then we gave them a promissory note and they're still not, we're not going to want to do business with them. And if they have to pay all the interest. And if this happens, you should still, you might need to turn into collections. You still need to try to collect this money, right? So a dishonored note, your accounts receivable is going to be debited, and then you credit your notes receivable and your interest income. And again here, we knew that this note was for $3,000. So we would take 3,000 times 0.08 times 60 divided by 360, because everything then is divided by 360, right? However many days they take it out, their note is always divided by, like here was 90, it's always divided by 360, because we use, to calculate that interest rate, we use 360 days. So I will walk you through work together. The sun is kind of... So this says to go ahead and journalize these dates. So the maturity value, this gives you the time, this gives you the interest rate, right? The principal is the initial amount that they owe. So June 5th, 20,000, 8%. So this is pretty, so they give you 90 days, 8%. So we take 20,000 times 0.08 times 90 divided by 360, right? Because however many days they want the note for, it's always divided by 360 every single time. Divided by 360 equals $400. So they're going to pay $400. And they took it out June 5th. So the maturity date is September 3rd. So 90 days from June 5th is September 3rd. That's when it's due. And the total amount that they're going to owe is $20,400. Okay? So it's the same thing down here. 10,000 times your interest rate times 120. This time their note is for 120 days divided by 360. So they're going to owe 200 in interest. And June 12th is when they took it out, and this is 120 days, so you're going to have a longer time period. So that means they're going to pay more interest, right? The longer you take a loan out, the more interest that you have to pay. I mean, like this is 20,000, they're paying almost double. So 200, so 10,200. Okay. And down here, it tells you how to figure that out. So this is how we find our interest rate, which I did up there for us. It's $400. And then we know the maturity value is just 20,000. This is the principal that we took the loan out for. Plus our interest is our maturity value of what we owe. And then, guys, walking you through how they figured out it was due, when it's due, September 3rd. So they took it out on June 5th. So June 5th till the end of the month, because there's 30 days in June, is 25 days, right? Okay, so then you take 90 minus 25. You still have 65 days to reach your 90 days. We know July has 31 days, so take 65 minus 31. We still have 34 days left. And we know August has 31 days. So that's 31. 31 minus 34, they have 3 days in September to pay to reach their 90 days. Right? So this is their maturity date is September 3rd. Okay? That's how they got their maturity date. Here, same thing. This is 120 days. They took out the loan on June 12th. There's 30 days in June. So you take 30 minus 12, you get 18. So they have 18 days in June. So you take 120 minus 18. They still have 102 days left paying on that loan. So you know July and August, 31 days each. So 102 minus 31. They still have 71 days. So if you have 71 days, that's pretty obvious that you still have 2 months to pay, right? Because there's 30 or 31 days in a month usually. So 31. So 71 minus 31 is 40. Okay, you have 40 days left. You know 40 days, that's at least a month, right? So your next month, September, has 30 days in it. 40 minus 30. So they're at the end of August, they have, or end of September, they have 10 days left to pay. So you're going to go into 10 days in October. So this is pretty, once you subtract your months from your days remaining, you know if you're above 30 or 31, this is going to be however many days are in that month, right? Until you keep dwindling down. Okay, and then again, you just take to find your interest. By the interest rate, the number of days, 120 is what the notes were, divided by 360, that's your interest. And then add it to your principal, and that is your maturity value. So that is how they did all of that. Okay, and then you just go through and you journalize them. So it says, accepted 90-day 8% for Gary Kinney for an extension of time on his account. So this has to be in accepted a 90-day note, right? So when we accept a note, it has to go in our general journal. So it's notes receivable. We debit for how much, and we credit their accounts receivable. Okay? And then you have to come over here, and you have to find Gary Kinney, and you put it in him in his own ledger. Just like everything, when we put something in our general journal, we always have to find their own ledger, right? And then it balances out. Gary Kinney, he goes in his own ledger. So we're done. And then we have to put it in our accounts receivable. Credit 1,800 and our notes receivable, debit. Okay, so we did 3 things here. We have to write it in our journal. Then we have to take it and we have to credit it to the account that it's going to, Gary Kinney. And then we have to put them in our accounts receivable and our notes receivable. Okay, so now July 12th, received cash from Mary Jane's for the maturity value, 60-day note. So to figure hers out, you would take, so received cash. So that gives us right there, received cash. Hers is going in our cash receipts journal because we received cash. So she took it out for 560 days at 9%. Okay, so we 500 times 0.09 times 60 days by 3, she's going to pay $7.50 in interest. So in our notes receivable, we have 500. Her interest is $7.50. So the total amount cash debit is $507.50. Okay? And then we have to come over here and we have to write in our interest because that's the first one we're paying interest on, right? And we credit it because it's a credit. So we credit our interest and then we're going to add it for our balance of how much interest, okay? And then don't forget, it's a notes receivable. So we're gonna have to write July 12th, notes receivable, $500. Because that's the initial amount. We already put our interest in our interest. So we just put it right here, okay? And it's a notes receivable. We don't do nothing with our accounts receivable in that one. Okay, this 26th. Dennis Craft, 90 days, note 9% at $400. So if you, okay, this is dishonored. So these are 3 that we have to do, right? This is a dishonored one. So we have to balance it back out. We have to put it back to accounts receivable. So we know, if we figure that out, 400 times 0.09 times 90 divided by 60 is $9. So we go accounts receivable / Dennis Craft. It's a debit. And then our notes receivable and our interest income, 409. So that's how we put that in our general journal. And now we have to come over here. So we have to write in our $9 that we had to pay in interest, right? We have to put it in our interest ledger. $9, credit to credit add. We have to put it in a notes receivable because it's still a notes receivable even though it's dishonored. 400. Okay. And then right here, our accounts receivable gets debited. So the opposite of what we did when we borrowed it, because this is a dishonored, for 409. And then Dennis Craft gets a dishonored note for 409 and 409. So don't forget, just like we do with everything that we do, when we put something in our general journal, we have to go put them in their own ledgers. So every time we have interest, it's going to go in the interest. We're going to put it in the interest. Anytime we have an accounts receivable, it goes in the accounts receivable ledger. The same with the notes. And then each person has their own account, right? So I hope this helped explain 14.3. So you'll do 14.3 on your own and send me a message of it. Again, you should be able to just follow along with what I did with the work together and work your way through it. Message me if you have any questions, guys. Okay.